Okay, so welcome to the T3 Tac Trade template. This populated with Amazon, and the stock is currently trading right around here, starting price of 88.5. Let me just double check that. I'll look at the real-time price. It is, let me change the scale. It's currently trading at 88.45, so close enough, 88.5. I want to acquire shares of this, and I'm going to use the T3 strategy, which is to sell out of the money put contracts. I may look at the stock and say, okay, the other thing I want to know actually is what's the implied volatility for an option that expires 30 days from now. So 30 days, let's just go there, is January 6th. That's 30 days from today. Today is December the 7th, 2022. So the implied volatility for the January 6th, which is in purple, is 42.5. So we'll just make it at 42%, which I have it populated there. And now I want to try and figure out how far out of the money I want to sell a put contract. So let's go down to the 80 strike. And on average, I'm not going to make that much, about $1.12. I could double check that or cross-reference, so let's do that. So an 80 strike, I've got it here paying $1.42. So the implied volatility is off a little bit. So to alter that, I'll just, so that's close enough. It looks like the implied vol for that particular series and that strike price. So that would be the January 6th, 2023 series with an 80 strike. It's got about a 46 implied vol with a 30-day options expiry. So let's go ahead and sell that. We'll bring in $1.40. We're going to sell 4 contracts, which is 400 shares. The application automatically calculates that for you. If we were to do this, for example, on 8 positions, 8 different individual securities using this particular strategy, the application would tell me I could only do 2 contracts. You see, so it automatically calculates. But let's go back to, let's just assume I'm going to do 5 positions. Let's go back and assume I'm going to do 5 positions. That allows me to trade 4 contracts or 400 shares. So I'm going to sell 4 put contracts with a $80 strike. It expires in 30 days. Amazon's currently trading at $88.50. I'm going to sell the $80 strike with a 46 implied vol. I'm going to collect $1.40 in premium. It's not that sexy, but it's an additional $560 in cash flow. And that's assuming we have a starting capital of about $250,000. And let's assume that we get assigned. So the ending stock value, it is user defined. So let's go ahead and just pretend, and we're going to war game. Let's just say it fell to 76. So the option did not expire worthless. We took assignment, and we go to step 2. We now have 400 shares that were put to us. If you remember, we sold the $80 put strike, and we obligated ourselves to having to buy the shares of Amazon if the share price fell below 80. Hypothetically, we're wargaming this and we're saying that the stock fell to 76. So what do we do? Well, the 400 shares that were assigned to us, we immediately go ahead and sell call contracts. So stock is at 76. That's the carry forward price from the closing price the previous Friday. So the next Monday morning, you'll wake up and find 400 shares of stock in your brokerage account of Amazon, and you put those shares up for sale. So you may say, I want to get an $80, you want to sell it at $80 strike price. We'll keep the implied volatility about the same. Let's just change it to 45. You'll bring in $2.41 on 4 contracts or 400 shares. That's $963. And at the same time, you're going to repeat step 1. You're going to be willing to acquire another 400 shares of Amazon. So what you do is you sell put contracts again. Step 2 is the only step within the T3 strategy that has a step 2A and a step 2B. So here, what we're going to do is we're going to sell, probably if it's down around 76, we're going to sell the $70 strike. So it would have to fall another $6 below 70. We'll get a very respectable $3.61, or on 4 contracts, that works out to $1,444. So we brought in $1,444 and about another $1,000, so about $2,440, probably about $2,370 or something like that is what we brought in step 2. Let's once again paint a worst case scenario. Now I've already done that, so if it finished at 75, for example, the trade is done. Actually, it's not. Let's just put this at, let's just say the stock rallied from 76, Amazon rallied, and it went to 81. Well, the option did not expire worthless. The call contracts had the shares called away from us. We sold the $80 strike. We basically put our shares up for, not basically, we did put our shares up for sale at a price of $80 if Amazon did get above that on the day it expired. In this hypothetical outcome, the stock did climb above the strike price of 80. It went to 81, and the shares were called away. This is incorrectly populated. We did not have to take assignment because it can only be either at above 80 or below 70. In this case, we said we would buy an additional 400 shares if Amazon fell below the strike price of 70. It did not. It finished at 81. Remember, step 2 is a two-part step, step 2A and 2B. But the final price on the day of options expiration can only end up at one price. So the put strikes, or I'm sorry, the put contracts expired worthless. That $1,444 is ours to keep, as are all the premiums. Whether you get assigned or not, you always get to keep the premium. So let's see how we did here. So on an individual leg, so this would be leg 1 or step 1, and in yellow that's step 2A and step 2B, or leg A and leg B, but it's step 2 in the strategy. So let's turn that on. So at the end of step 1 we were down $1,000 exactly. I'm sorry, actually we're down $1,040. Step 2A, where we net up $2,563 on step 2A, and in step 2B we were up $1,444. Let's go ahead and add some other metrics. We're going to leave this one till N, dollar difference. Cumulative premium collected. How much have we brought in? Well, we brought in $560 on the sale of the original put contracts with an 80 strike. There's the strike price we sold, and that's how much we brought in, $560, which is reflected right here. At the end of step 2A, we sold call contracts with an $80 call strike. We brought in $963. So cumulatively, $963 plus $560 totals $1,523. On step 2B, we sold a put contract. We sold the $70 put strike. We brought in an additional $1,444. In total, we've now brought in $2,968 in option premium. So let's just go ahead and put on the cumulative trade progression. Well, the trade is actually completed at the end of step 2. Originally we were down $1,040. Then at the end of step 2A, we were at $1,523. And when we add in step 2B, which is the sale of the second put strike at $70, the option did not go below 70. It went above 80, hypothetically, and the shares were called away. $2,968 is what we made on the trade before commissions. But let's go ahead and model. Oh, by the way, how would we have done had we just decided to buy the shares? You said, you know, let's make myself investor B, and this would be investor A. Amazon is at $88 for investor A. Amazon is at $88 for myself, who would be investor B. As investor B, I chose to sell put strikes to acquire the shares. Investor A just stepped in and said, you know what, I'm just going to go ahead and I'm going to buy 800 shares of Amazon. Well, how would that investor have done had he gone in and bought at $88.50? By the time the trade was done, he or she is down $6,000. So let me explain where that math comes from. Let's assume here, which is one of the great things about this tool, is you can model any what if. Let's assume it falls below that $70 put strike that we sold. So if Amazon kept falling to say 69, or there we go, we have it at 68. First thing we know is that the call contracts that we sold, the $80 strike price, those did not get called away. The shares still stay with us. Those expired worthless. And we know that the put strike, it fell below 70 because it hypothetically went to 68. They did not expire worthless. We took assignment. Okay, so now we're still in the trade. So once again, hypothetically, at the end of month 2, Amazon finished at 68. It's now down on a collective basis 24.65% from the starting price of $88.50. So let's now go to step 3 or month 3 right here. We now have 400 shares plus an additional 400 shares. We got assigned here at the $80 put strike, and we were assigned here at the $70 put strike. On a cumulative basis, we now have 4 and 4, and we took assignment here for 400 shares, and here for an additional 400 shares, totaling 800 shares. We're now long 800 shares. There is no more put sells, just step 1 and step 2B. In step 3, all we do now is put our shares up for sale. So the stock is currently trading or closed at $68 at the end of month 2. At the end of month 1, it was 76, and then it fell down to 68. And that's where we start month 3. You open up your brokerage account the following Monday morning, and you see that you now have 800 shares of Amazon in your account. And you say, I just want to unload these shares at this point. So maybe we sell the $75 call strike. The implied volatility, actually the implied volatility on the previous leg was a little bit high. It's sitting at 74. So let me go ahead and bring that down. And we'll bring it down to about 45, which is what the call strike was at. And it changes your profitability greatly. So there you go. We brought in $963 and $590. Same strike prices. We sold the 80 call, sold the 70 put. I just forgot to update the implied vol, and that of course has a huge effect on what the cost of the option premium is, whether we're buying it or selling. In this case, we're selling. So at any rate, at the end of month 2, Amazon closed at $68, hypothetically. And the beginning of month 3, you open up your brokerage account and you've got 800 shares of Amazon because you're assigned. Because once again, the stock fell below the $80 strike, it closed at 76, and then it fell below the 70 strike and it hypothetically closed at 68. We now are long 800 shares of Amazon. So the price is $68 the following Monday morning, and we say we want to unload all 800 shares of Amazon, and we model out 70 or 75. We could look at the 70s, and let's go ahead and not forget to change the implied vol. Now just keep in mind, this is a market that started at $88.50. It's fallen in the last 2 months an additional 24.65%. Chances are the implied volatility will rise. So I had it at 45. I'm going to put it at, be realistic, and put it at like 48 for step 3. So stock opens at 68, and we consider modeling out, or we model out rather, the $70 call strike. So how would that look if we got called away? We'd make very, very little money. Okay, so you could already see right there, we'd net out $477 on the entire trade. But if we decided to sell the 75, and let's say at the end of the month the stock finishes at say 76 and the shares get called away, we now made $3,259 in profit by the end of month 3. Not too shabby. What's that look like in a way of rate of return? Let's just take a look. Right there, T3, individual step and annualized return. So each step has its own rate of return depending on where the stock finished. So by the end of step 3, so we have step 1, step 2A, step 2B, there's step 3. On that individual leg, you would have made 11.46% on that individual step. On a cumulative basis, you click this little second check mark here. So if we annualize that on a cumulative basis, if we could do that every 90 days, 30, these two represent another 30, so that's 60 in total, and then another 30 for the 3rd month, that's 90 days. So if you can do this 4 additional times, once again, if I uncheck this, about 11% every quarter or every 90 days, if I annualize that out, it's 55%. Not too shabby at all on a stock that moved against us substantially. Let's see how far it moved against us, and that's what these metrics are for. Let's go to the underlying instrument cumulative move. So at its worst, it was down 24.65%. But because we collected all these premiums as option sellers, let's see how our percentage move protection since inception. So since we started this trade by selling the 80 put, then selling an 80 call, and then selling a 70 put, and then selling the 75 call and having the shares called away. So here the trade would be done. If we got called away and the shares were at 68 and then closed anything above 75, hypothetically we have it closing at 76, the shares were called away. But once again, this is a rinse and repeat strategy. So what if it didn't go above 75? Not a problem. Let's say it went to just 74. It was close. Shares are not called away. They expired worthless. The following morning, on the next Monday, which would be month 4, you still have the same 800 shares. Because unless it goes above 75, which it did not, it went to 74, it was close, but you were not called away, meaning you still own those 800 shares at the end of step 3. So we go on to step 4. Now I've got a crazy strike price in here, so what you do is you just use the spinners and you let it drop all the way down to something where you would be comfortable selling call options against your shares. Basically, what are you willing to sell your 800 shares for? So I could say now the stock started at 88.50. It's all the way down to hypothetically 74. I really think now that the market is going to bounce. So the investor would say, sell me the $80 calls. We go ahead and change the implied volatility. We'll put it around the same as before at around 48. And you can expect to bring in $1.96 against 800 shares. So $1.96 times 800 is $1,565. That's how much money you will be bringing in by selling 8 call contracts against your 800 shares. Okay. And once again, we use the spinners to figure out where we finished. So that's a little bit ridiculous. This was populated with a different security prior to me running these models on Amazon. So let's say the stock goes from 74 all the way up to, okay, I've got it at 90 there, so let's bring it back down a little bit more. 74, let's say it goes to 83. That's a big move. That's a 12% move from the previous $74 close. And now the shares are called away. Now you can see how we did. 8,824 in profit. A share purchaser would have been down $4,400. You can see what our cumulative profit was as a result of selling premiums. We brought in $4,824 in option credits. So that mitigated our drawdown, but more importantly, it boosted our return. And that's what this button is for, dollar difference. So I'm going to turn it on. How well did the T3 strategy do relative to just going in there and buying 800 shares at $88.50? Well, remember, we didn't have to buy our shares. I would be investor B. We didn't have to buy our shares until it hit 80. And even then, I got $1.40 in premium. It's break even to the downside. So selling premium and acquiring the shares at a more competitive price than where it's currently trading can be very advantageous. It was in this scenario. Now, had the stock rallied and gone straight up, maybe it went up to 95, then the share purchaser would have outperformed this strategy because he or she was correct on the direction. They stepped in, they bought 800 shares of Amazon, and lo and behold, it did exactly what they thought and it went higher. But often the case, that is not often the case. In many instances, the market will go sideways, the market will drop, you will get stopped out. A number of different things could and can happen when trading stocks. So this is a little more conservative in its approach. Again, I'm also optimistic that Amazon will go higher, especially as we approach the Christmas season. I know numbers are expected to be down, but I'm not too sure how much. But anyway you look at it, the justification as to why you're buying is irrelevant with this strategy. I mean, yes, you have to have a reason for going in and doing this strategy. I'm optimistic or bullish on Amazon, but I also have built-in safeguards, whereas the long-only share purchaser is the only safeguard he or she has would be to use a stop loss or to do what I do, which is part of this strategy, which is sell call contracts against their inventory being the shares. So I'm having the inventory put to me. That's why it's called a put contract. Whereas the share purchaser just goes out there and said, what's the going price? Yeah, give me 800 shares at $88.50. I'm assuming he or she has a lot of money and a lot of capital. So again, this is the individual leg net profit or loss. This is the dollar difference. So in the end, how did the T3 strategy do? Well, made $8,824. The share purchaser lost $4,000. That gives us a net difference of, the share purchaser lost $4,400. So the dollar difference in favor of the T3 tack trade template strategy is $13,224. And that's what this pink metric means. There's another metric. There's a number of different things that I can show, but I'm not going to get into on this quick tutorial. But if you click this button, it's one of my favorite right here, which is called percentage profit due to premium. So of all this profit that we made $8,824. How much of that came from just collecting these premiums against 400 shares each time? And how much came from the gain in the actual share price? Let's take a look. Okay, so this is exactly what you want to look for. Of the $8,824 that we made in profit right here, 54% of that profit came from these premiums right here that we collected when we sold option contracts. Sorry, it's this one as well. Okay, so when we sold call contract, or sorry, puts, and then we sold calls, and then puts, and then calls, and then calls, and it finally got called away, we brought in $4,824 in option premium, but we walked away with $8,824, and that's because we raised the strike price that we're willing to sell. We said we don't want to sell at 75, now we want to sell at 80. Sure enough, in this hypothetical outcome, Amazon went from 74 up to 83. That was a 12% move. Oops, it was a 12% move, but it was good enough for us to sell our shares at a strike price of 80. As a result, 54.67% of our profit was because of premiums. And so 54, so that means the other 46% that we made of the 8,824, that came from the price appreciation. So the shares were put to us, and then we turned around and sold them at the $80 strike price. So a very, very powerful metric, a very powerful application. I've just scratched the surface. There's a number of other different worksheets along the bottom for somebody who's considering just investing in real estate, but we're not going to get into that during this quick tutorial. Okay, thanks very much, and thanks for watching. And once again, tack trade template. This allows you to model any what-if scenario on a go-forward basis, and it's a great risk management tool if you're considering a strategy like this. Thanks for watching.